Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. With the NASDAQ and S&P now in new high territory, what should investors do differently with their holdings? The chief investment strategist at Nuveen is shedding some light on portfolio tactics to consider in the current market environment. Plus, Shopify's chart is the focus of this week's technical analysis. We'll also be going one-on-one with the e-commerce software platform COO to learn more about the company's growth trajectory. And XOUT Capital is here to discuss the methodology behind its index, which has the goal of eliminating holdings that are the most at risk for disruption. Investing Strategies starts now. Let's kick things off with our market insights for the week. The stock market is moving full steam ahead into new high territory. And here with me now to discuss the current investing environment and how investors should be positioning their portfolios now is Brian Nick, Chief Investment Strategist at Nuveen. Thanks so much for joining me today, Brian.
Thanks for having me.
All right, now solidly in new high territory. What is your take on the market right now?
Well, it's been a pretty extraordinary run over the last couple of weeks. I think we've seen the base case probably stay kind of where we thought it would be, sort of mediocre growth. We got the 1.9% GDP number for the third quarter, kind of confirming our sense that things have slowed down. The rest of the world doesn't look like it's speeding up. Might be stabilizing at relatively weak levels in China and in the Eurozone. But I think what's really happened to help the market get this extra boost is some of the downside scenarios seem to have melted away or at least diminished. You look at the idea that there's going to be a no-deal Brexit. That seems to have diminished for the time being. The trade war seems like it's gone off the front burner. The October tariffs were delayed or canceled. Looks like the same thing might happen to the December tariffs. So if we're at sort of the high watermark for tariffs, that's another sign that the markets may see it as a sort of an all clear to climb higher. And valuations still aren't as expensive as they were, say, 2 years ago, coming off of the passage of the tax cut bill. So we feel okay about where things are. We've been pretty surprised about how quickly they've moved. We're not looking for that same trajectory moving forward, but we're pretty happy with the underlying fundamentals supporting this market.
Interesting. So you think that the shifting story with the trade war is really just eliminating basically the worst case scenario, but maybe not setting us up for a powerful move higher?
Yeah, my message for the fourth quarter to investors is literally this isn't the worst case scenario. And I think that's been enough. I mean, you see the tail risk start to get priced out. Interest rates rise a little bit. So this idea that investors are running for the most defensive, safe areas of the financial markets, and so government bonds, and even in Europe, rates have come up just a little bit. Not because I think that we've seen this spectacular new economic scenario unfolding for 2020, but if you were really concerned about some of the dangers out there, you're probably a little bit less concerned today and a little bit more apt to want to take a bit more risk in your portfolio.
All right, so then looking beyond Q4, over the next 12 months, what is really your anticipation for growth of global equities? Still not intensely strong, but a bright picture, would you say?
Now, given that we're up sort of globally in the sort of the high teens, low 20s, we're not expecting anything like that for 2020, similar to what we've had in 2019. I think we're going to be held hostage a bit to earnings growth. That's going to be sort of the leash holding us back. You look at this quarter, it looks like earnings growth might come in, just eke out a positive year-over-year gain for the third quarter. We could see something similar in the fourth quarter, and then I think the expectations for next year are a bit too high in the consensus. So we're looking for mid-single-digit earnings growth. Tie that to our return expectations, maybe 4 to 6% on the S&P 500, something similar for other global indices.
All right, well, let's talk sectors then. What sectors do you think investors should be watching right now, especially when you're talking about earnings prospects?
Yeah, so it's been a sort of a game of pinball with the sectors. From quarter to quarter, you've had this kind of dramatic shift in leadership. Technology has been one of the most steady. We think that's going to continue to be an outperformer. The trade war sort of melting away just a bit is good for technology stocks, although they weathered the trade war pretty well considering they're sort of at the center of things between US and China on trade. So we still like technology, but at the same time we were adding to technology in the last couple of months, we've also been adding to utilities, which is not an inexpensive bet at the moment, but it's also a high dividend sector. And because we think total returns are going to be relatively low, that means the dividend is going to be a larger component of those returns. And we still aren't exactly sure that we should be completely dismissing the downside scenario from our outlook. So something like utility is very defensive, high dividend, is a pretty good insurance policy to have in a mix of equities.
All right, and then what are your thoughts on semiconductors standing out lately after a period of underperformance?
Well, again, this is at the sort of the core, the crux of the U.S.-China trade war and trade negotiations. So if it doesn't look like they will get higher tariffs on existing goods, a lot of which are these kind of semiconductors or technology taxed each time they do, then the semiconductor market looks a bit stronger. And again, tech's one of our favorites for 2020. I think we were going to put our money on sort of a more cyclical, more of a upside scenario. It would be in semiconductors, but I think in technology more broadly. So we like it, but the trade war is kind of throwing this sort of binary variable into the equation. If it gets worse, we expect that sector to get hit pretty hard again.
Right, and you mentioned investors potentially getting a little bit more aggressive now with their portfolios. So what else would you say in terms of positioning portfolios would be key to consider right now in addition to the tech sector?
Well, we know for all year investors have been pulling their money out of ETFs and mutual funds that are targeted towards equities, and they've been putting their money into cash and fixed income. So it's still a pretty bearish individual investor out there, if we could sort of distill it into one person. I think for next year, where should we be looking? Income is still a big consideration for a lot of investors. It's something we focus on a lot at Nuveen. Emerging market income, U.S. corporate bonds still look relatively good compared to other options you can get on things like cash, government bonds. We talked about getting income in the equity markets. That's the thing that we hear the most from investors. How can I continue to generate income in an environment where you have sub 2% U.S. 10-year Treasury yields that seem like they're here to stay for the time being? If they get a little bit above 2%, it won't be by much, at least in the next year.
All right, fantastic. We'll have to leave it there for now, but thank you so much for all of your insights today.
Nice to be here. Thank you.
All right, and coming up after the break, we're going to take a look at the chart of Shopify. Is the e-commerce software stock setting up for another big move higher? We'll discuss when we come back.
Leaderboard helps you invest better with winning stocks picked by our team of experts. Select a stock to see current analysis. Check the chart for buy and sell points, plus get real-time price alerts. Improve your investing with Leaderboard. Start your free trial today.
When you see a stock make a massive move and you're sitting on the sidelines, you might be feeling like you've missed out. But there's a silver lining. The very best stocks will always present another buying opportunity. You just have to be patient and wait for it. Shopify is a great example of a top stock that's made a monster move this year. Shares broke out of a 7-month-long consolidation in February and proceeded to run up from around 177 to 409 in a little over 6 months. Now, during that time, the stock was able to find support at its 10-week moving average. That's the red line on this weekly chart here. So the first two pullbacks and rebounds off of the 10-week line after a breakout are considered opportunities to add shares to an existing position. And aggressive shareholders can also use these pullbacks to initiate positions. And after such a huge run, it's not surprising to now see a new consolidation for Shopify. Investors should also note that even with the big run up, this new base is not considered a late stage base because this last consolidation was long enough to reset the base count. Now, this is key because later stage bases have a greater likelihood of failing since they come after a stock has already made a giant move. Now, this current consolidation comes amid broader weakness in the software group, but Shopify is still holding well above its 200-day moving average. That's this gray line on the daily chart here. And shares are now trading about 23% below highs and a potential buy point at 409.71, which is 10 cents above the prior high right there. So what would fuel the next move higher for the stock? Well, earnings and sales growth are huge contributing factors. In the most recently reported quarter, Shopify reported a loss of 25 cents a share, and that came after several quarters of accelerating bottom line growth. Still, the stock did not give up much ground on the earnings results, and revenue growth has been slowing slightly, but it was still a solid 45% last quarter. Analysts are bullish on Shopify's international expansion, and Shopify is building a U.S. distribution network to store and ship products for its merchant customers, with plans to spend $1 billion over 5 years to do so. Whenever a company's initiatives boost earnings and sales growth, that typically bodes well for the stock. All right, well, coming up next, we're going to go one-on-one with the COO of Shopify to discuss how these latest strategic initiatives are set to impact the software platform's growth trajectory. We'll be right back.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Shopify stock has been on an astounding run this year, more than doubling in price, and the company now powers over 1 million merchants on its platform. Joining us remotely via Zoom to discuss the e-commerce software company's growth trajectory and strategic initiatives is Harley Finkelstein, the COO of Shopify. Thanks so much for joining me today, Harley.
Thanks for having me.
All right, so now more than 1 million merchants on Shopify. Why do you think merchants are increasingly coming to the platform?
Look, I think entrepreneurship is nothing new. I think the issue historically has been that it was difficult for entrepreneurs to access a global market. It was very expensive, it was very complicated, and software technology just wasn't built for them. The history of the company was really around building software to allow entrepreneurs, people that are makers and creators, and even curators to build beautiful online stores and then take it to a global audience. And we now have 1 million merchants that have done that on Shopify. They've sold more than $135 billion. And actually, if you aggregate just our US stores alone, we're the third largest retailer in the US online. So we're seeing a lot of great growth. And what we're really doing is leveling the playing field so that entrepreneurs can compete.
Interesting. So if you're considering yourself a retailer, then it does seem like it's more than just the software platform. Now you're expanding to distribution centers. Can you tell us a little bit more about the thought process behind that move to expanding with distribution centers?
Sure. So as I mentioned, the history of the company was we were the best in the world at helping small businesses build beautiful online stores. But a couple of things changed over the last 5 years or so. The first thing that changed was that e-commerce moved to commerce everywhere, where now consumers want to purchase wherever wherever their preference is. So they may want to buy offline or on Instagram or on Facebook or on eBay or Amazon. And so more and more what Shopify has transitioned into is the world's first retail operating system, where you can use Shopify to sell across any channel you want and access customers anywhere in the world using those channels. That's the first thing. The second thing was we began to think about what are the other challenges that entrepreneurs have? Things like shipping and payments and capital and logistics. And if you take a lot of small things and aggregate them, you actually get a really big thing. And what we realized was that we had the opportunity to go negotiate on behalf of 1 million merchants, do things they couldn't do on their own, and give them the economies of scale. So in the case of capital, for example, we've now given out more than $700 million to small businesses who couldn't access capital on their own, shipping labels, better pricing on shipping labels, payment rates, and more recently, fulfillment. We've announced about 4 months ago that we're creating the Shopify Fulfillment Network so that any entrepreneurs and any small businesses in the US can put their products into this network of fulfillment centers, and they can provide their customers the same type of delivery options that traditionally only the biggest companies on the planet are able to afford. And again, all you're seeing here is this incredible democratization of entrepreneurship and this leveling of the playing field so that any small business can compete with the biggest businesses.
Right. So then do you think that this approach really gives the merchants an edge over what they would get via Amazon, which of course is the 800-pound gorilla in the e-commerce space?
Yeah, look, often when you talk about e-commerce, companies like Amazon, of course, come up. And Amazon does a good job of selling you the things that you need to buy, your household items, your commoditized products. But more and more consumers want to purchase products from the people that make the products. And what technology has done, what Shopify has done, is we've allowed these businesses to scale at a much faster rate. And they no longer have to rent customers from the marketplaces. They now can have their own customers that they own themselves. And when you look at companies like Allbirds or Bombas or Fashion Nova or Kylie Cosmetics, these are brands that didn't exist 5 years ago. And now they're some of the largest brands in their category. And they've been built entirely on Shopify.
So Shopify's expansion, these investments, obviously a short-term impact on earnings, but what do you think that the long-term payoff will be? Will the company be able to turn this into a growth opportunity, and how quickly?
So the history of the company was we were profitable in the early days. We were bootstrapped, and we plan to be profitable again. But right now, it feels like the opportunity for us is just so big. We think that we can help more merchants in more places and provide them more services. And so right now we're really focused on ensuring that the most amount of people use Shopify. And then once they come onto the platform, they use more and more of our services. But from a financial perspective, you're seeing growth of 45% year-over-year revenue growth. We announced Q3, our revenue was about $390 million. GMV was almost $15 billion. That's almost 48% year-over-year. So these are really wonderful growth numbers, but we feel like there's a big opportunity for us, and we need to continue investing right now.
Right. Speaking of top line growth, how sustainable do you think 45 or even a 30+% top line growth is as you continue to grow?
Well, if you go back a year and a half or so ago, Shopify really focused mostly on the English-speaking world. We were a company focused really on North America, UK, Australia. More and more now, you're seeing merchants in all countries all over the world begin to use Shopify. We've translated our product. We've integrated with the right payment gateways. We're developing an ecosystem of partners globally. So we think global expansion will certainly help with that growth. Shopify Plus, which is our enterprise offering, is growing leaps and bounds. We're seeing brands like Procter & Gamble and Unilever and Gatorade and Aerosols come onto Shopify. These are brands that traditionally may have not done that. So more and more, as we create more services, enter new markets, and provide more products for those existing merchants, we think we continue growing at a similar pace to what we've been doing.
All right. Well, thank you so much for giving us a look at the company's strategic initiatives. It's definitely been fun watching the stock and seeing the company grow. Thanks so much for being here today.
Thank you so much.
Okay, well, after a quick break, we're sitting down with XOUT Capital to learn about the quantitative rules-based methodology behind its XOUT US Large Cap Index. We'll be right back.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
When new innovations spark industry disruptions, only the companies that can adapt survive. Well, now there's an ETF, ticker XOUT, that has the goal of eliminating holdings that could be ripe for disruption. And joining me today is the CEO of that ETF's index provider, and that's David Barse of XOUT Capital. Thanks so much for being here today, David.
It's wonderful to be here. Thank you.
All right, so give us a quick little premise of what the index is really going after.
Yeah, look, there are two primary focuses. One is the most important or significant forward-facing risk that all investors and companies are facing is technological disruption. And if they don't think or focus on that, that's a big problem. And the second thing is we've come up with a strategy that's something intuitively simple, but no one's doing it, which is it's more important what you leave out of your portfolio than what you leave in, thus the name XOUT. So we're eliminating those companies that are or likely will be disrupted by technology from a broad-based index, and our first index is the 500 largest companies in the US.
Right, and let's dig a little bit into the methodology. So what line items are you really looking at and you're honing in on that are the signifiers for what's in and what's out?
Yeah, so if you think about technology and what it might be doing to disrupt companies, there are things like growth, hiring, capital expenditures on business, what the analyst community might think about a business, whether that company's profitable or not, whether the company's investing in its own stock through buybacks. We use a multi-fundamental economic measurement to create a score. And the bottom 250 companies that score get eliminated from our index.
Right, and with the focus being fundamentals, have you, or in creating the index, did you consider at all adding in price performance as one of your metrics, and why is that left out?
Yeah, we have a management factor that we call it that has price performance as its key indicator for us, because how else to judge a CEO, for instance, who's running a business, than the price of the security at which time he or she takes over the company to the present day, and you compare that against all the other companies in your constituency. So we use price performance just with a slightly nuanced manner.
Got it, makes sense. And then I think, I guess it could be called a classic example now of disruption, Blockbuster, that whole model really being disrupted by Netflix. But now this year we're seeing all of these streaming services come out, and Disney and maybe some other more old school media companies look like they may potentially be disrupting Netflix. So how do you take that into consideration?
Yeah, so the index rebalances quarterly, and companies that perform better in the current quarter might end up getting put back into the portfolio. So that that elimination decision, or Xing out of, as we call it, is not a permanent one. It's one that looks at the here and now. What kind of information are we receiving from financial statements that are produced on a quarterly basis, and then the score is assigned. So Disney, which is actually X'd out today, may be in the future put back into the portfolio if its financial performance starts to meet and exceed the scoring of the 250, so it doesn't get on the bottom of the list, right? But today they're getting a lot of headlines because of all the money that they're spending, but they're really catching up, quite frankly. And so it'll be interesting to see if they're successful at it.
Right, and IBD, we are all about looking at data and making decisions based off of that data. So how do you think that this type of approach is really enabling investors to put aside their biases when it comes to picking which, I guess indirectly, which stocks are in their portfolio and which ones aren't?
I mean, this is one of the things that I've learned in my professional career, that biases tend to have strong influences over individual active security pickers. And so if you create a rules-based methodology and you stick to those rules, you have a good chance of eliminating those biases. The active component of what we do is really the creation of the index. Once we establish those rules, we sort of systematically have set up an active rule-based system, but now it's permanent, right? That rule is in place, we will not change it, and the biases hopefully go away over time. We tend to look at some financial data that one might say, well, is that the right way to examine what might be disrupted or not? And that's open for debate. There are thousands of factors that you can use to create the elimination decision. And I'm not saying we find the perfect one or multi-ones, but we've done a pretty decent job, we think, with what we've created.
All right, and this is a large cap index, so are you going to apply this to other areas of the market moving forward?
Yeah, ultimately our goal is to create a suite of indexes that are really based around disruption in some cases, and maybe in other cases a different thematic way in which we eliminate from a portfolio companies that should be excluded from the portfolio, but it'll be driven around the business. In other words, where are asset flows going? We know they're going into the largest U.S. market cap companies right now.
Right.
But small cap, mid cap, international, which are currently out of favor, but maybe they'll be in favor over some period of time in the future, and that's likely where we'll focus.
All right, well, thank you so much. We'll definitely keep an eye on XOUT.
Thanks for having me. It was great.
All right, and thank you all for watching Investing Strategies. Next week, I'll be joined by Tangler Wealth Management, Wisdom Tree, and MasterCard. Until next time, I'm Alissa Coram.